When it comes to safe and steady investing, bonds are one of the first things you'll hear about. But what exactly are bonds? How do they work? And why are they considered lower risk than stocks? Let's break it down step by step. Welcome to Grow My Savings. In this beginner's guide, you'll learn what bonds are, how they pay you income, the main types of bonds, why they're considered safer than stocks, and the risks you still need to watch out for. Think of a bond as a loan. When you buy a bond, you're lending money to a government, company, or even a city. In exchange, they promise to pay you regular interest, called the coupon rate, and return your original money, the face value, when the bond matures. Most bonds have a face value of about $1,000, and interest is usually paid twice a year. Here's how it plays out. You buy a bond. The issuer uses your money for projects or operations. You receive steady interest payments. At the end of the bond's term, you get your principal back. But bonds also trade in markets. Their prices move daily depending on interest rates and credit quality. If rates rise, bond prices fall. And if rates drop, bond prices go up. There are several types of bonds you might come across. Fixed rate bonds. Same interest payment for the whole term. Floating rate bonds. Interest changes with the market. Convertible bonds. Can be turned into company shares later. Zero coupon bonds. No regular interest. Instead, you buy them at a discount and get the full amount back at maturity. Compared to stocks, bonds are more predictable. They give you regular income, promise principal repayment if held to maturity, and stabilize portfolios by reducing overall volatility. That's why bonds are popular with conservative investors and retirees who prefer steady cash flow over big risks. But low risk doesn't mean no risk. Bonds still carry interest rate risk. Prices drop when rates rise. Credit risk. The issuer could default and miss payments. Market risk. If you sell early, you might not get full value. So while bonds are safer than stocks, it's still smart to check who you're lending to and how long the bond lasts. Bonds are ideal for conservative investors, anyone wanting steady income, or those who want to balance riskier stock investments with something more stable. Would you add bonds to your investment strategy, or do you prefer sticking with stocks for growth? Let me know in the comments below. So to recap, bonds are loans you give to governments or companies. They pay you regular interest and return your money at maturity. They're safer than stocks, but still come with some risks. If this helps simplify bonds for you, don't forget to like, subscribe, and join me next time on Grow My Saving as we cover the difference between stocks and bonds.